The Nifty and Sensex have been falling consistently for the last 5 months. In doing so, both have become extremely oversold across a series of parameters, especially what we call as sentiment indicators that we can go over one by one. But what has really happened is that you have seen a 5-month consecutive fall. Now, the last time that we really had a 5-month consecutive fall was way back in the year 1996. Yes, that is very, very long back. We're almost talking 29 years. And back then, after that fall, what really followed was a 8-month recovery in the markets back to the previous highs. So that is what we need to be really prepared for when markets get this oversold and everybody becomes this nervous. What you're really looking for is a lasting recovery in the market over the next several months to follow. And investors and traders alike need to really be prepared for that possibility rather than getting carried away by the nervousness that is really there in the market right now. So over a period of couple of months, I think we should be basing out or bottoming out closer to the 22,000 mark, plus or minus, a few hundred points that can happen because of volatility, but eventually start recovering back towards the highs. It may not happen all at once. It could happen in various stages or steps. But initially, you might just, retrace maybe 50% of the fall that we've really seen. That is how markets start recovering. And then as the news flow starts improving, you might see further gains going forward. So depending on the time frame that we really look at, you might find that the Nifty or the larger index breaks, several moving averages over time. And while it was below the 20-day moving average, we eventually broke the 20-month moving average for the month of February. Now that's a serious break, but we also saw a similar break in the year 2022. And eventually, after doing that for 1 month, the markets recovered. So it ended up being a false signal. Therefore, this might be a little early to look at this particular reading and say that, just because we've broken the 20-month moving average, it may be a negative signal. It can be a false signal as well. Now, how would we really know that it is a false signal? So here are a couple of data points. One, that seasonally, markets are always weak between Jan, Feb and March. February ends up being the weakest month of the year. So we actually saw a, almost 5-6% decline this month. And historically, that's how it has been. It also is seen that markets start recovering, maybe a little bit, or fall somewhere and bottom out in March, and eventually recover into the months of April, May, June. So this is an ideal time for the markets to really be basing out if we go by the historical seasonality of the index. The next thing is, since we are talking about moving averages, we can also measure the number of Nifty 500 stocks that are trading above the 200-day moving average. Yes, that's a very, very interesting measure. And what has happened in this fall, because it's been so sharp, that now you have only 9% of stocks which are above the Nifty, within the Nifty 500, above the 200-day moving average. So you only have 9% of stocks above the 200-day moving average out of the Nifty 500 basket. Now, when you achieve this kind of a situation, this is the worst reading that you have since COVID. In COVID, you had a reading of almost 5%. In 2022, when the Nifty fell to 15,200 and people were also very fearful, the reading was 15%. So this reading is lower than where we were in 2022. And it's actually now comparable with the COVID lows. So when you have this kind of an extreme situation where most stocks have broken their 200-day moving average, the chances are you're closer and closer to a final market bottom, where most stocks have capitulated on the downside. And therefore, investors really need to look at the opportunity to start investing at these levels. So the way the Nifty has fallen has been, pretty one-sided. The bounces also during this fall have been quite small. So when we compare it to historical, bearish phases where you could see sharp retracements of 50 to 60%, this time around, we have actually not seen any meaningful retracement in the Nifty during the fall. So there's no chart pattern that we can really say has developed like a triangle or a rectangle or a basing pattern that we can really judge the setup by. The best way that we are really looking at this setup is by looking at sentiment indicators. So we're actually trying to look at the positioning of FIIs versus DIIs. So if you actually look at what foreign institutional investors are doing, they have built up the highest amount of short positions in index futures in India Okay, so this is the highest on record since data became available in 2012. And that shows that they are extremely pessimistic. Now, historically, whenever FIs get this pessimistic, it's been closer to the lows. And the reason for that is that FIs continuously hedge a falling market. So their positions don't get built up in a day. But as a market keeps falling on a day-to-day basis, week-to-week basis, their positions keep increasing. And if this is the largest, means that they have significantly hedged themselves against a further fall. And that's because the markets are already meaningfully down. So that is why the odds are that you're closer to the lows. Now, while this is one data point, you also need an opposing data point, which has only built up now. What is this opposing data point? Domestic institutional investors. Yes, historically, at certain longer term bottoms or medium term bottoms, domestic institutional investors have also gone ahead and taken a meaningful long position in the market. When we say it's meaningful, we are measuring it in terms of number of contracts. And these are, of course, adjusted for the changes in contract size that have happened over time, say from 25 to 50 or 75. So when we look at the DII data, we find that domestic institutions are now close to a longest position since March of 2023. Yes, that is the last time that markets were down, and that was after the Adani fiasco. And then we finally found our lows in March of 23. And that's when DIs had built up a significant long position. And we are now getting closer to that. And it's only happened in the last couple of weeks. Prior to that, even while FIs had a short and had a hedge, DIs had not really built up such a strong long position in the market. And now that they have done that, as we are getting closer to 22,000, it's a better signal that domestic institutions are strongly supporting this market and we can actually get a meaningful recovery. So markets have fallen a lot. Like I said, they've already broken their key 20-month moving average. But at the same time, we are now in the zone of where we had fallen during the election of 2024, right? The national election that took place, we had a panic sell-off in the market where the Nifty actually broke 22,000 and went all the way down to 21,200. And since then, it saw a recovery all the way to 26,000. Now, since 26,000, we've been falling consistently over the last 5 months, and we are now back to the 22,000 level. So this is a very, very important support. We do believe that somewhere between 22,000 and 21,200, we are going to see a bottom. In fact, it's possible that if you don't break 22,000, you might not even see 21,800 or 21,200, which a lot of people are looking for. So it's going to be a very critical point, 22,000, because you have several Fibonacci ratios, various analysis that really points that this is a key level where you can get a reversal. And therefore, we will first watch 22,000, and only if it breaks will we consider lower levels as possible. If it ends up holding, then we could get a recovery from here. So that's a very interesting question, because we have seen the Indian market break away from the US market since September. Prior to that, we had a pretty good correlation. In fact, the US market is what we move most closely with. But we've also seen certain correlation breaks that have happened during this period in other markets as well. For example, over the last 1 month, European stock markets have gone to an all-time high, even though the US has been in a corrective phase. Similarly, we've started to see China find a base and start to pick up. Now, these are very interesting trends, and it requires us to step back and actually understand why this is happening. The reason I understand is that many of these markets and many of the central banks there have started to ease policy and provide stimulus to the domestic economy well ahead of the US and well ahead of India. So because they were doing that in advance, their markets have recovered sooner. And this does not look like a global catastrophe. So while there is some volatility in the US market, it is true that the Indian markets have broken away from what is happening not just in Europe, in China, but also in the US. But many parts of Asia have been affected over the last couple of months simply because you were under an environment of a strong dollar and rising bond yields. A lot of that has changed during the last 1 month. The dollar has started to fall. Bond yields have started to come down. And the best part is that just like the other economies that have already recovered, the Indian central bank and the government have already started to stimulate in many different ways. We have liquidity measures from the RBI, we have an interest rate cut, We have injections of swaps into the currency market to stabilize that. And so the entire macro situation has already started to change. It's just not yet reflecting on Indian equity prices. And I do believe that if Europe has managed to recover back to all-time highs, and if China has managed to make a much higher bottom than where it was a year ago, then India should not be behind. Once this selling pressure, which we are seeing right now, eases, then the positive effects of all the liquidity measures will also show up on the Indian markets too, just like other parts of the world. And it's then that you will start seeing a correlation between India and global markets start to mean revert all over again. But for the time being, it does look like we have broken apart, and I believe that that's a temporary trend which should be closer to the end. So the RSI indicator is a very classic tool that is commonly used by most traders to track where the market is. In fact, even longer term investors may look at it on a weekly or a monthly chart. And the weekly and monthly readings have actually gone back to where we were, in 2022. So that's really going back to when the index was at 15,200. Okay, so that's the last correction that we have seen post-COVID, and the RSI readings on weekly and monthly charts are back to those levels. Now, what is also interesting is on the daily chart, the RSI is actually broken below all the lows that we've made over the last 4 years since COVID and gone to a reading of 22 to 21. These are extremely oversold readings in the Nifty that we haven't seen in quite a while. And again, this is an indication that we are probably at the fag end of the selling round that we have seen just now. And the combination of lower RSI readings on daily, weekly and monthly essentially tell you that it's likely to be not just a short-term bottom, but a medium to longer term one as well. The financial sector in India has been particularly interesting, and the reason for that is that over the last 2-3 years, many of the financial and banking stocks, specifically private banks and the NBFCs, were trading in a very, very narrow range. Now, this was despite earnings growth, and a lot of the blame for that really went to FIIs who've been selling in India and hold a large part, large cap, specifically banking and financial stocks. So despite earnings growth, because these stocks were in a trading range, their valuations came down considerably. Now, what is happening over the last 2 months is that a lot of funds that are receiving, mutual funds that are getting additional money or who have created cash are reallocating money to undervalued sectors, and within that, the financials have started to outperform. So we actually look at below the surface, specifically some of the private banks, or we look at the NBFCs that are popular, that are part of the index. They bottomed in January and already on the rise. So this sector has been outperforming, even though the Bank Nifty particularly may not have taken off. And in fact, it's also holding like near a double bottom at this point of time compared to where we were in January. Several of the stocks inside it have actually already started to move higher. So there's a clear positive trend in the banking and financial space because mutual funds have taken interest in buying undervalued stocks, and that is where money is really going. So there has been some degree of rotation. We just discussed how money has moved into financial stocks. Something similar like that is also visible in the metal sector. The metal sector has been holding its lows throughout the month of February. Some of the metal stocks have also moved up during this time period, even as the Nifty is headed lower. So what that really shows is that there is buying interest in particular areas as money is getting reallocated. But unfortunately, this is not a trend that we see across the board. We don't see it in the autos. We don't see it in reality. Okay, we don't see it still in PSU stocks, even though they do have very low RSI readings and are very, very oversold. So there has been some degree of rotation, some sectors, but not yet across the board. But we do feel that you will start seeing it, basing out. So there are two parts of the market, right? One which is outperforming, so that is clearly visible. Others which are probably very beaten down, and we need to start looking for momentum reversals there. And like I mentioned, possibly PSU stocks, which were very, very active last year, might be one place to really look out for that. So we're really not seeing significant intermarket divergences between Nifty and mid-caps. They appear to be there for some time, but most of them have been broken. The only index which is showing some divergence has been the banking sector, which we spoke about earlier. and the new low in Nifty not being confirmed by a new low in Bank Nifty is one form of intermarket divergence. You would have liked to see the same kind of thing even between mid caps and large caps, but you're really not seeing anything of that as of now. It appears that the selling in mid caps and small caps has eventually ended up, rolling over and spilling over into the large caps as well.